How to RPM your finances, an investing guide for beginners. Your savings account is yawning, isn't it? Inflation, that silent thief, is eating 3 to 4% a year, while your cash just naps at a paltry 0.5%. 10 years of that, and a 10 grand emergency fund quietly turns into just 7 grand of buying power. Pretty unsettling, right? Ready to finally break this frustrating cycle? In the next 8 minutes, I'll hand you the exact starter kit that got me from zero to confidently invested with honestly less drama than ordering a complicated coffee. All right, let's talk about the real MVP of investing: compounding. Imagine a tiny snowball you push down a hill. The further it rolls, the more snow it picks up, growing exponentially. That's your money, working for you, even while you sleep. Here is a mind-bending example. If you consistently invest just $200 a month at an average 8% annual return, starting today, you could be looking at roughly $350,000 in 30 years. Now, here is the kicker. If you wait just 5 years to begin that same journey with the same monthly contributions and the same return, you'll finish a staggering $120,000 lighter. Same cash, same return, but a very different clock. The moral of this story: the market isn't looking for psychics who can predict the future. It rewards the patient and, most importantly, the early. Before you even think about flinging money at stocks, you've got 2 critical steps. First, park a solid 3 to 6 months' worth of living expenses in a high-yield savings account. That's your essential financial airbag, your peace of mind. Second, absolutely nuke any credit card balances that are north of 10%. Seriously, investing when you're carrying high-interest debt is like trying to fill a bucket with a massive hole in the bottom. You're just pouring money away. Plug that leak first. No guilt, just smart physics. Okay, let's cut through the jargon. For beginners, you really only need to get cozy with 3 core investment labels. Stocks. Think of these as tiny ownership slices in actual companies. When the company does well, your slice tends to get bigger. Bonds. These are essentially IOUs. You're lending money to a company or government, and they pay you back with interest. Generally less risky than stocks, but with lower potential returns. ETFs, exchange-traded funds. Imagine a Costco cart overflowing with a diverse mix of both stocks and bonds. You buy one ETF, and you're instantly diversified across many different assets. The best part? They trade just like single stocks, making them super accessible. Memorize those 3, and congratulations, you're literate enough to confidently open an investment account. Now, forget all that Hollywood fantasy of hand-picking the next moonshot stock. That's a high-stakes gamble most pros can't even consistently win. Your secret weapon, especially as a beginner, is far more elegant and effective. Buy the whole market instead. An S&P 500 ETF, for instance, doesn't just own one company. It owns tiny pieces of the 500 biggest companies in America. Trying to time the market, guessing when to buy low and sell high, is like trying to catch a falling knife blindfolded. It's a recipe for stress and usually for losing money. Instead, embrace dollar-cost averaging. This means you simply autopilot a fixed amount of money into your investments every single payday, no matter what the market is doing. When prices dip, your fixed sum automatically buys more shares. When they rise, you buy fewer. Over decades, this simple, consistent math smooths out all that market volatility and, crucially, keeps your emotions safely out of the driver's seat. It's truly a game changer for long-term success. Ready for the fun part? Opening your investment account is surprisingly easy, often just 3 clicks away. Pick a no-commission brokerage. Think big names like Fidelity, Schwab, or Vanguard. They're reliable, beginner-friendly, and won't charge you for every trade. Pick your flavor, link your bank, and transfer funds. Only transfer money you genuinely won't need. for at least the next 5 years. This is crucial for riding out market ups and downs. Search, buy, confirm. Look for a broad market ETF like VO, which tracks the S&P 500, or VTI, which tracks the total US stock market. Hit buy, enter the dollar amount you want to invest, review it, and then confidently swipe to confirm. Congratulations, you're officially a business owner. Time required? Honestly, less than signing up for a gym membership. If this information is genuinely clicking for you, do me a quick favor, tap that subscribe button. You won't want to miss the upcoming video where I break down the exact ETFs I've chosen for my own mom as portfolio. Free knowledge, absolutely zero spam. Deal? Let's be real, markets wobble. Expect 10% drops most years and significant 30% crashes about once a decade. It's not a question of if, but when. The ultimate antidote to this fear isn't trying to time the market, it's having time in the market. Every red candle on the chart, every headline screaming doom, is actually a sale for your long-term wealth building, if your horizon is long enough. Write down your financial goal, stash away your brokerage password somewhere safe, and practice the art of productive ignorance. Check your portfolio quarterly maybe, not every 5 minutes. Let it breathe. Investing can feel overwhelming, but avoiding these common beginner blunders will put you miles ahead. Right? Panic selling when headlines scream? Markets always recover, eventually. Selling low locks in your losses. Chasing last year's hot tip. Past performance is never a guarantee of future returns. What was hot yesterday might be frozen today. Ignoring fees that look tiny. A 1% fee might seem small, but over decades it compounds into a massive leak in your returns. Always opt for low-cost funds. Skipping diversification by going all in on one sure thing. Don't put all your eggs in one basket. Even the surest things can surprise you. Avoid those four, and honestly, you've already beaten half the so-called pros out there. Here is how to supercharge your progress. Automatically raise your contributions with every single raise you get at work. Even a tiny 1% bump now beats a frantic 10% scramble later. Automate your investments, increase them regularly, and then just repeat the process. 10 years from now, you'll open that app, blink twice in disbelief, and realize the money you practically forgot about is doing the overtime you never had to work. It's a magical feeling. So you walked in here with maybe a little idle cash and a serious headache from finance jargon. You're walking out with 3 incredibly powerful yet simple moves. Open that account, buy a broad market ETF, and then feed it on schedule every single month. No crystal ball, no 6 monitors, no fancy finance degree required. Just start with $50 this week or whatever you can comfortably spare and let this powerful engine run. Your future self is already high-fiving you. Make sure you answer that call. If you got real value today, please smash that subscribe button, drop your first-time investor questions below, and I'll see you in the next video where we talk about some killer retirement account hacks.